Today's guest is the first of his type on First Principles. He's a venture capitalist. Sorry, he was a venture capitalist. While the idea of what sorts of founders or leaders would make for great guests has been evolving since August 2022 when we first started, I was clear about one thing. They would not be venture capitalists. Why? Because I wanted to bring founders and leaders who had skin in the game, who were all in on their beliefs, who were committed to building products, teams, brands, and organizations against all the odds, against the odds of failure. Now, with all due respect to venture capitalists, they're facilitators or enablers, not builders or doers. So, when I reconnected with Alok Mittal, the co-founder and chairman of small business lending platform Indifi, I was really interested. Because Alok, who I've known for nearly a decade now, is a rare entrepreneur who's also a former venture capitalist. He set up Canaan Partners in India and ran it for nearly a decade before starting Indifi, his second startup. Back in 1994, fresh out of IIT Delhi, where he was a gold medalist, Alok was struck by the idea of being your own boss and the lifestyle that came with it. So much so, he was sure early on at his time in IIT Delhi that he wanted to be a startup founder. He explained how he jumped into his first startup, ZipAhead, which later became JobsAhead early on in life, fueled by the promise of the founder lifestyle.
JobsAhead was an interesting story. There is a friend of mine, Puneet. Both of us went to IIT together, and I decided, I think halfway through my IIT stint, that I wanted to be an entrepreneur. Right?
Do you remember what the trigger or nudge or inspiration was?
No, very clearly. So I interned at a company called CMR Design Automation in Greater Kailash. And there was another IIT alumni, Chandra. I recently reconnected with him. So he was running his own company in his basement, top quality work. And I loved the lifestyle. He could walk down and work in the basement when he wanted, and he could walk up for lunch. So I said, this is what I want to be. So it was a very, very 19-year-old view to what you want to be, but that stuck. And in 1997, 98, I was beginning to get anxious about I need to do this now. And I was in Bangalore. I was living in Bangalore at that point, and Puneet happened to come there, and he said, hey, I'm looking at starting an internet business, and we should chat. And literally he came over to my house in the evening. We sat through the night, and somewhere during the course of that night, we said, yes, we're going to do this. Interestingly enough, we didn't have the idea kind of baked in at that time. We just said we're going to do a startup in the internet space, right? I came back to Delhi then. And then we kind of first put our head to what the idea should be. We launched a business called ZipAhead in November of 1999.
Was that also in the careers space?
So that had 4 services for all Indians. All Indians were all 1 million Indians at that time. And that had 4 channels: careers, fashion, e-commerce, we were selling books, and dating. So we said we're covering all the needs of the Indian audience. And then as soon as we launched, within literally the next 15 days, the users told us that they were only interested in careers. So 85% of our traffic was going to the careers page. So then subsequently over the next couple of months, we just pulled out the careers piece, branded that JobsAhead, and focused all our resources on that. So that was, in some sense, the idea emerged as we executed.
The idea emerged as we executed. This is a great takeaway for all the soon-to-be founders out there who are waiting for that one great idea. And it must be said, when you're young and hungry and want to be your own boss, allow yourself to take that shot. There was a lot more ground that Alok and I covered over our conversation at a studio in Gurgaon where we recorded this episode. Another thing he told me, and that stuck with me, was how he saw failure and learnings. I'll not reveal what he said just now, but you'll surely find it interesting as you go through my conversation with guest number 39, Alok Mittal. Welcome to First Principles. I'm your host, Rohin Dharmakumar. Let's get started. First Principles is one of the podcasts from the Ken, India's first subscriber only business publication. In my day job, I'm also the Ken's CEO. If you think these episodes are well researched and produced, then you should check out the Ken's premium subscription. In a world filled with noise, competing agendas, PR messages, and breathless exclusive with flashing red lights, you'll find the Ken the perfect antidote. We publish just a handful of long form stories, newsletters, and podcasts each day because we know that intelligent people aren't looking for an all you can eat meal filled with empty calories, but meaningful journalism that helps them make sense of the world and the future. Some of the interesting stories we published in just the last week were why more 40 somethings are becoming unwilling retirees, how Ajit Dayal's pint-sized mutual fund is taking the fight back to ICICI Bank, why it might be trouble for JioMart if quick commerce will soon be all of grocery e-commerce, how Nvidia's AI chips are about to flood the Indian market but there don't seem to be many buyers, and why Xiaomi's Porsche-inspired electric car is a risky ride even in the world's biggest EV market, China. That was roughly 30% of what we published just the last week. So, head over to theken.com to discover what other stories, newsletters, and podcasts we have for you. And if you like us, subscribe. Trust me, it will be an investment worthy of your time. Early stage investing is a risky business. If you're not making the wrong calls, you're not taking risk perhaps. Alok, this is something that you said around the risks and the bets that a venture capitalist must make. And of course, you've been a venture capitalist for a significant amount of time in your career. Around the time that you started Indifi, what do you think were the risks?
In the Indifi business.
Yeah, I mean, you starting a new startup, what were the risks?
Yeah. So I think the disruption in the market space, which is what was causing the opportunity, but also represented some of the risks, right, were around digitization of small businesses. Remember, this is pre-UPI days.
Yeah, you started in 2015.
15, yes. Yeah. So I think pretty much the only segment of small businesses that were reasonably digitized at that point were sellers on e-commerce platforms, probably just that. And hence, it was unclear how fast small businesses will digitize and how fast the rest of the lending ecosystem would digitize. Now, clearly, we've come a long way since then, right? I think demonetization was the first lever for digitization, as much as it was disruptive to small businesses from a cash flow standpoint. But it did ensure that every small business, had a electronic payment acceptance.
The precursor to that would have been also the GST introduction, right?
GST kind of kicked in later. So demon was December 2016. The GST wave came in more like 2018. And that clearly has been, again, a big driver to formalization. The balance between the cash business for a small entrepreneur versus what flows through their balance sheet, has changed significantly. COVID, the overall rise of internet as it relates to small businesses, right? And one of the key insights that we built Indifi around initially was this belief.
It's Indifi. I pronounced it as Indifi. My bad.
One key insight was that most of the internet platforms, even in 2014-15, while they looked like consumer businesses, they had small businesses on their supply side, right? So whether it was a Make My Trip, which was selling hotels, whether it was an Amazon or Flipkart, of course, which had small business sellers, whether it was IndiaMart, which was a B2B listings marketplace. And we thought that all these businesses are trying to provide a marketing channel to SMEs. What about layering credit on top of that? Right. So that thesis has over time played out, and that has both led to digitization, but also allowed us to build a business leveraging that digitization. But sitting back in 2015, all of those were risks.
So you was that like what you saw as like a secular inevitability that an economy the size of India and the kind of internet business that are getting built, it was only inevitable that this would get digitized?
Yes, yes. So you could argue that maybe the only risk is the timing risk. Um, but certainly, I think in the last 8-9 years that we've been around, um, the digitization has been faster than what we would have imagined in 2015. So today, I would argue that at least 20-25 million of Indian businesses are reasonably well digitized, where their businesses would lend themselves to digital finance.
Why is digitization so important for lending?
So, if you look at the whole notion of digital lending, and one, it is interesting because it's a fad. But I think from a core business standpoint, it's really interesting for maybe three different reasons, right? And I'll take a pure Banya view of this, right? Start from the P&L. One, increasing digitization should allow you more efficient access to customers, right? So just your CAC should come down, right? And the more you can access
By that
is
you mean for a lender
for a
being
lender.
able to find SMEs, the cost of
Yes.
acquisition comes down.
Yeah, right. Because the traditional method of branch-based origination is essentially knocking on doors physically and then generating demand through that. And if you can approach small businesses through their natural business channels, you have context, you have information on when to approach whom. Digital marketing inherently is a lower cost marketing channel than people walking on the streets. Second, your quality of underwriting through availability of digital data should go up, both in terms of the standard of underwriting, but also in standardization of underwriting, right? So one of our beliefs, and we are seeing more and more of that pan out now, is
Could I
that,
ask you to explain underwriting? It's
okay,
the risk of,
so underwriting is essentially selecting your customers, right? If 100 people walk through the door, who amongst those are you going to give credit to versus who you're not? And the
so in some sense it's equivalent of what credit assessing credit
assessing
worthiness.
credit, yeah. And the trick is that out of 100 that you give out credit to, just normatively speaking, 95 of those should return you money. Maybe it's 97, maybe it's 93. But if the number of people who are returning back your money goes below 90, then by and large, you don't have a business, right? So the ability to discriminate credit at that level is something that has been done for decades using human beings. But it's very hard to standardize that. So, large NBFCs in India would have different standard of underwriting in branches 5 kilometers away, right? And in some sense, those companies take pride in that because, at some level, they are localizing their risk assessment. We think that as a business scales up, that becomes a disadvantage because then the control on what kind of risk as a company you are undertaking goes away. And hence, if your underwriting basis data-driven models, if your fraud assessment is technology-driven, then you have a solid foundation on which you can start to build the business. The third piece is the operational cost, right? And through the use of digital technologies, you can improve the self-serve behavior of customers, thereby bring down the operational cost, right? So if I start to look at the profit and loss stack for a lending company, these three are three significant costs in doing the business. There are three significant hurdles in scalability of the business. So that is really the founding hypothesis of Indifi on saying, if you can use data and technology, which we kind of compose into saying if you can use digitization to lend, then these benefits can accrue to the business and in turn to the customers, right? So today, 85% of Indian MSMEs don't have access to financing because as an industry, we haven't solved for these three elements for
All
them.
right. While you were speaking, I couldn't but help notice the contrast in Alok Mittal as a VC and Alok Mittal as an entrepreneur now, which is as a VC, you're essentially trying to figure out, I mean, in both as a VC and as a lender, you're trying to figure out how to deploy capital in
Mhm,
some ways.
mhm.
But as a VC, you're not looking for credit worthiness. You're not looking at how many people will be able to return the money, right? You're essentially looking for those multi baggers where you're accounting for a certain amount of failure and saying it's all right if there's this high failure rate, just as long as some of them are multi baggers and they will return. And it's almost like a contrast with what you're doing with lending, which is you're saying, look, I don't want multi baggers. I want most of them to return my money safely. Therefore, I'm looking at credit worthiness.
That's exactly true. In the lending business, your income is capped, your losses are uncapped. In the venture business, your losses are capped, 1x of capital,
Hmm.
but your upside can be several times the capital deployed. So the ratio between the positive side, upside, and the downside is completely inverted between a venture investment business and a lending business.
So fascinating, right? Like, that mirror inversion that you've done. Um, how would you describe Indifi in a line or two?
So I think our core mission is to be able to solve for this underpenetration of credit among small businesses. Right? The core lever that we are deploying or leveraging is digitization. Right? But end of the day, we are a lending business, and to that extent, the kind of trade-offs that we just talked about are the heart of the business. Risk management is the heart of the business.
So, when you say you're a lending business, you're a lending platform. What does that mean?
So we call ourselves a lending platform because on the supply of capital side, we don't deploy all of our capital. So traditionally, banks and NBFCs have deployed all of their capital being itself a mix of equity and debt. Our view is that our balance sheet is not the most efficient balance sheet out there. Right? My cost of borrowing today would be more than twice of the cost of funds of large banks. And to that extent, what we do is we also allow other banks and NBFCs to participate through our technology platform and lend to businesses that we are originating. So today, as we speak, about 60% of our business happens on our balance sheet. However, 40% of our business is through such partnerships where we are not participating in the loan, but we are enabling the loan and we are managing the loan, bringing the advantages of credit underwriting, operating cost, origination to other lenders.
Is that, I mean, to a layperson, it looks like, doesn't that create internal conflict if, by your own admission, if you said that your cost of capital is higher versus a much larger bank that comes and deploys, isn't there a risk that they're able to lend at a much more competitive rate and thus crowd you out from your own platform?
Yeah, so the reason why their cost of capital is lower and the reason why 85% of the market is unserved is because their risk criteria are also much tighter. So in the example I gave earlier, they would not even tolerate 95% people paying that. They want 99% of the people to be paying back, right? And sure, when we originate, we have a mix of people, of which some we expect 98, 99% to pay back. And those people expect to get a 15%, 14% cost of funds. We would send them to large lenders. And then we would capture the value that is represented by our platform in terms of credit losses and operating cost. And then there are people where we expect 92% people to pay back, 8% not to pay back. And large banks don't want that demand. So that is what we would serve using our own balance sheet.
So it's a riskier set of customers, but with a higher potential return.
I think there are two things here. So one, as perceived by the market today, they are riskier set of customers, right? I think a core motivation for starting Indifi also came from my own experience as an entrepreneur. I failed to accept that 85% of Indian entrepreneurs are non-credit worthy, right? So we think that there is a credit discrimination problem here, which is how do we separate the good borrowers from the bad? See, ultimately, even at a 90% payback rate, it's only 10 people who are defaulting. 90% are still paying back. But those 90% don't get served because we can't differentiate at the point of giving them a loan as to who are the 90 or the 10, right? Now, if we can discriminate better and we can tell these people apart, then all those 90 people are bank lendable, right? So the discrimination in current credit risk models is what is preventing these 90 people from getting credit, right? Now, what our core expertise is and where, what will make us win is the ability to say, okay, I'm able to, exclude 20% of the population, which captures 8 people who are risky. So now I'm left with 80, of which 78 are good and 2 are bad, right? And if you can do that, then that's the arbitrage in the market, because the bank still believes that it's 90 and 10. Our credit models allow us to take a bet that it's 78 and 2.
So you said your credit models. I mean, and I'm assuming that your ability to remain competitive and ahead of others rests a lot on your proprietary credit
That's
models.
correct. That's correct.
How were they built and how do they continue to be better than others? Because assuming it's a overall lucrative market, I'm fairly certain others will be trying to enter and do what you are doing and try to come up with a better credit model, so to speak, or a larger balance sheet, so to speak. So why are your credit models better than others, and why will they continue to be better than others?
So, I fundamentally believe that competitive differentiation, sustained competitive differentiation, does not come from technology, right? It comes from a business strategy. So, for example, for lenders, whether banks or NBFCs, who have extensive branch-based infrastructure, investing in digital credit models has a limited advantage, right? They've been doing things a certain way. They already have people on the ground. The credit officer can go and meet every business, right? Since we are remote, and that is part of the strategic bet that we have taken, it forces us to invest in credit models and find the better credit models over time, right? So my desire to build a better credit model doesn't stand as a strategic choice in isolation, right? It stands with my belief that this will be a remote business. 5 years from now, all micro SME lending should be digital, right? And if I buy that, then I'm investing more here. I'm making that choice. The reason the large bank won't do it or is not doing it is not because they don't have the ability, but just that is not a choice that they are willing to make, given that they've got, 10,000 branches, given that they have lower cost of capital, so they don't really need to solve this problem. There's enough of the 98-2 mix, which is landing up at their doors, and that is affording them 30-40% growth a year. They don't need to solve this problem, right? So in some sense, we are surrounding ourselves with a business model which is consistent, right, across digitization, across solving for the credit model, across lowering operating cost. In some sense, all of that is coming out of the fact that our cost of funds in the foreseeable future will never be lower than theirs.
All right. Would it be fair to say that the way Indifi makes money is through the difference between what it borrows and versus what it lends, plus charging your other lenders a fee for using your platform?
Yes, so those are two separate streams. When we lend using our own balance sheet, we make money from the difference between what we borrow at versus what we lend. And then when other lenders are coming and using our platform, they pay us a fee for using the platform.
Could you give us a sense of how much of loans or how many loans has Indifi dispersed to date?
Yeah, so we would have disbursed just in excess of 100,000 loans, about 50,000 active customers. Some of those would be repeat customers. In terms of dollar value, 6,000, 7,000 crores disbursed.
What's a typical, I know it must be a large range, but what's an average or a typical size of a loan, SME
So our
loan?
average loan is a 7 lakh rupee loan for a 26-month duration.
All right. I have a quick couple of questions on Indifi before I move on. You started in 2015. How many employees are there today?
We are about 900 people. As I mentioned earlier, we are largely a remote operation. So we have one office in Gurgaon, and that's it. We have a collection infrastructure which is all across the country. So there'll be about 50 people who are on the field collecting. but 850 people are in one location.
So they work out of an office, or
Yes.
like, I mean, when you say remote, you mean
Remote relative to the
yes,
branch-based
yes.
model.
I mean, for a minute, I wanted to ask you if it is a true remote that these 850 people are just working out of their homes.
No,
That
no, no, no. This is they work out of office. They're remote relative to the branch-based infrastructure that the lending
I
industry
got
rely
that.
on.
You've raised venture capital as well.
Yes, we
How
have.
much of venture capital have
We've
you raised?
raised 5 rounds of capital so far, totaling about $90 million.
And one of the questions I ask all, this is the first time I'm having a venture capitalist turn entrepreneur on my show, but I must ask you, is there a number related to your valuation that you've disclosed on what Indifi is
No, we
valued at?
haven't. No, we haven't.
All right. How many co-founders do you have?
So we started with 3. So myself and, as you know, I didn't have any prior background in lending. So the first thing I did when I decided to do this business was to make a Facebook post saying, hey, looking for a co-founder. This was way back in 2014. And I found my co-founder through Facebook. Siddharth, he comes from a lending background, risk management all his life. And then we had a third co-founder who was our C2 at that one point in time. Unfortunately, that relationship did not end up being a long one. But yeah, Siddharth and I are very much in the business.
Hello, hello. We'd love to get some more feedback and ratings from our listeners. So, if you haven't rated us already, please do so on the podcast platform or app you're currently listening to me on. You can also write to us at fp@theken.com. We love hearing from our listeners and subscribers. When I looked at the Indifi side, one of the things that stood out, and of course, you talk about the kind of business loans you give, right? Term loans, invoice discounting, letters of credit, vendor payments, etc. But more importantly, what stood out to me was that you mentioned 4 or 5 very specific sectors: travel, e commerce, startups, hotels, restaurants, and retail. Why are these 5 or 6 sectors so important enough? Usually for me, it's like when a company mentions something so prominently, there's a reason behind it. Otherwise they would not mention it. Why are these sectors and mentioning them so important for you?
Right. So I think there are 2 elements to that. One is we believe that we can mitigate risk better or we can assess risk better if we have sectoral depth, right? So, for example, restaurants are notorious globally for their
For
shutdown rates,
failure rates, that's right.
right? So, about 15% of restaurants go out of business every year. And hence, if I have to assess the risk in a restaurant, I'm not just assessing credit risk, I'm also assessing a business survival risk. Right? E-commerce sellers are very sensitive to price discounting on the e-commerce platforms. So I have to be able to understand, is this business likely to undergo price commoditization and hence loss of margin?
It looks like you're bringing some of your venture capital knowledge also to bear here, because business risk and like shutdown risk, etc., is that
This
normal?
notion is very, very standard in the lending business. So you will see that most lenders, I'm not talking about consumer lenders here, most business lenders will adopt a degree of sectoral focus to be able to understand these.
So how does just out of curiosity, how does a lender get to know which restaurant is likely to succeed or not? What kind of data informs their model?
So at a very coarse level, a classical lender may look at a 3-year history of a restaurant as sufficient to guide their assessment on whether the restaurant will survive or not. Right? So younger restaurants tend to die more than restaurants that have survived
So
for
you've
3
gone
years.
past the 3 year,
Yeah,
this thing,
so
chances of survival are higher.
right now, in our case, because we are relying on far more data, we have built what we believe is a better model for predicting the same outcome. So we could look at a 1-year restaurant and predict whether they are going to survive or not. But the concept is exactly the same.
Could I ask you, I mean, obviously not going into your whatever your proprietary model, but what are some of the signals that go into
Consumer
predicting
love.
whether?
Consumer love. You will hear that language a lot in the
So you'll
startup space.
essentially look at ratings on
Ratings,
Zomato and
reviews. Are they in the premium segment? Are they in the value segment? Depending on which region are they operating in, what cuisine are they into. So some cuisines in some regions tend to be more volatile than others. Staples tend to be less volatile. Right? So once you put all of that data together, you're able to build a better predictive model. than 3 years, yes or no.
So something that you said earlier was a lot of the classic lenders tend to have geographically distinct lending strategies. What you seem to be saying, it's less about geographical distinction, but it's sectoral distinction. You
Both.
need to be able to understand travel
Yeah,
sector better.
yeah, that is true for both geography and sector. That is true for both how conventionally lending is done to businesses and how we do it. Right. So that part of it is similar. How are we coming to these predictions is different. Right. So that is kind of the reason why sectoral bias becomes important. Right. Um, the
And what's common to these sectors?
Yeah,
Hotels, restaurant,
yeah. So
travel.
so that's the
Yeah,
second piece, right? Of there are 100 sectors out there. Why are we choosing these five or six? Right? And that comes back to where is the wedge of disruption for us. So as I mentioned earlier, there are certain assumptions we are making on the pace of digitization of certain sectors, right? So if you look at our rubric for making a decision of which sectors to go into, they will entail how digitized that sector is and how fast is digitization growing. We largely look at that along two axis. One is the credit model axis of saying how fast is data getting digitized in that industry. And second is the customer self-serve dimension of how comfortable are users in that segment using a mobile phone for getting a loan, for example. Right. So in that sense, we've gotten into retail because UPI happened. Right. When we started our company, we were in e-commerce, we were in travel. Travel had already digitized by then. Travel agencies were making bookings online. Right. So successively, our choices of which
got it.
sectors we can go into is driven by the pace of digitization. And then obviously we look at scale. We don't want to be solving for very small sectors, which
So
might be
so if I may
digitized.
kind of simplify that, what you're really saying is that if a small business owner is natively comfortable using technology for their business to run it on a day-to-day basis, then they're most likely to generate digital data and be comfortable with receiving or borrowing digitally, and that's one of the things that's really important for you.
Yeah, and we are looking at the persona of that small business owner, not just from their business usage of technology standpoint, but also their personal uses of technology. These are all proprietor-driven businesses. So if I'm a rockstar user of Paytm, then it's likely that I can absorb digital credit.
What does that mean?
That means that from a customer journey standpoint, KYC standpoint, these users are familiar with what it takes
So
to
you're saying if
onboard.
they're already using some specific tools for a
Right.
lot for their business, fair enough. Alok, you're both a first generation entrepreneur as well as a serial entrepreneur. If I'm not mistaken, you're the first in your family to become an entrepreneur.
In the startup sense, yes.
Yeah,
Yeah,
that's right, right. And of course, you're a serial entrepreneur as well. Uh, Three, probably, if I count Canaan as well, because you set up Canaan in India,
that's correct.
right? So there's a very interesting, I think, mix that we see in you. So your first startup was Jobs Ahead,
That's right.
and you sold that to Monster.com. Where did that come about? And
JobsAhead was an interesting story. There is a friend of mine, Puneet. Both of us went to IIT together, and I decided, I think, halfway through my IIT stint, that I wanted to be an entrepreneur. Right.
do you
And
remember what the trigger or nudge or
oh,
inspiration
no,
was?
very clearly. So I interned at a company called CMR Design Automation in Greater Kailash. And there was another IIT alumnus, Chandra. I recently reconnected with him. So he was running his own company in his basement, top quality work. And I loved the lifestyle. He could walk down and work in the basement when he wanted, and he could walk up for lunch. So I said, this is what I want to be. So it was a very, very 19-year-old view to what you want to be, but that stuck. And in 97, 98, 1997, 98, I was beginning to get anxious about I need to do this now. And I was in Bangalore. I was living in Bangalore at that point, and Puneet happened to come there, and he said, "Hey, I'm looking at starting an internet business, and we should chat." And literally, he came over to my house in the evening. We sat through the night, And somewhere during the course of that night, we said, yes, we're going to do this. Interestingly enough, we didn't have the idea kind of baked in at that time. We just said we're going to do a startup in the internet space, right? I came back to Delhi then. And then we kind of first put our head to what the idea should be. Uh, we launched a business called ZipAhead in November of 1999.
Was that also in the careers space?
So that had four services for all Indians. All Indians were all a million Indians at that time. And that had four channels: careers, fashion, e commerce, we were selling books, and dating. So we said we're covering all the needs
Wow.
of the Indian audience. And then as soon as we launched, within literally the next 15 days, the users told us that they were only interested in careers. So 85% of our traffic was going to the careers page. So then subsequently over the next couple of months, we just pulled out the careers piece, branded that Jobs Ahead, and focused all our resources on that. So that was in some sense, the idea emerged as we executed. But yeah, that was the first one.
You
That
did that
was
for about, what, 6 years before you sold it?
99 to 2005. Yeah.
And then you became a VC.
Yeah, that was quite accidental. So once I sold Jobs Ahead, I was looking to start my next business. I had a couple of ideas on the table. And again, I went to meet another friend, Rahul Basin, who was at Bearings. I still remember, I think it was the 13th of September, Friday and Saturday. And he said, hey, while you're looking for your next business idea, Bearings has classically been in growth equity. He said, we want to build venture as an asset class, and why don't you come join, help us build venture while you're looking for the next idea, right? And Monday I was at Bearings, trying to build venture cap for them. Unfortunately, that relationship did not, land up being a long one. But around February timeframe, Canaan was then looking at setting up shop in India. That discussion materialized. So end of March, I joined Canaan to set up their presence in India.
And you did that for close to 10 years, if I'm not mistaken.
Yeah, 6 to 15, so 9 years.
Yeah. And then, of course, you left Canaan. Canaan got sold.
No, so
or
Canaan,
it got acquired by JP Morgan or its assets?
so the first thing that happened was, Canaan was investing in US, India, and Israel through a common global fund. And Canaan wanted to focus that fund on the US market. So essentially, there was a choice to say, do we want to raise another fund or we don't, right? So for our partner in Israel, for example, said he'll raise a separate fund, Canaan Israel, and went down that route. In India, me and my other colleagues here all felt like that's not what we wanted to do. I wanted to be back in entrepreneurship. Rahul Khanna, who was my other partner, wanted to set up a broader financial services play. And to that extent, we said we don't want to do that. And then we had a portfolio of companies. So the next task for me then was to make sure that we land the portfolio right. And in that process, we landed up selling it to JP Morgan. So the decision to sell to JP Morgan was an outcome of the other decisions.
After nearly a decade stint as a VC, how was your second stint? How did it influence your second stint as an entrepreneur? Did it?
I think in some ways it did. I think the notion of, what creates value in a company was kind of better baked in my mind. And that's probably the reason I wanted to get into a second operational stint. When we started the first company, it was a dot-com boom. The notion of what creates value in a company, right, was very different. We were younger. I don't think we had an understanding of what happens there. I think the second piece that was very clear in my mind was the time it takes to build a company, right?
What is that, if I may ask you?
I,
If you had
I
to put
think at
down
the
a
lower
range
end,
of years.
I think at the lower end it's 10 years, and then depends on how much you want to kind of ride the compounding, right? But I'm hard pressed to come up with companies that got built to a reasonable scale in less than 10 years in the Indian market, right? So really, when we started this company, both me, my co-founder, both of us started with the view that there's kind of no end timeline that we are putting to this. In the sense that we will build it and we'll continue to build it and we'll see how it goes. But really, if it works and if we continue to enjoy what we're doing, we're here indefinitely. So I think that mindset was certainly different from when I started my first company.
If you had to give that same advice to other entrepreneurs who are starting up, how would it change the way they go about building their business, especially when it comes to raising venture capital? Because often, while venture capital is an enabling force in order for you to kind of set up and scale a business, it also imposes certain constraints on the need for exits, either an absolute exit or as a cyclical series of exits where one venture capitalist is exiting to another, etc. So, what would
Yeah.
be your advice to someone who's thinking, hey, I would also like to build a business for the long run?
Yeah. See, I think one of the things which is important is building a business in the right sequence, right? Availability of venture capital or private equity is opportunistic. And to that extent, there is this instinct of if money is available, raise more. And I completely buy that. However, what
So,
we
sorry, when you say you buy that, you
I
mean
would
you.
take, I would raise more money if more money was available,
All right.
right? However, the notion of using capital to jump the sequence in which you build a business. For example, let's build market share before we've really got PMF. Right? I think those are the kind of
That's product market fit.
yes, yes. Those are the kind of decisions that I think are not consistent with building a long-term business, right? Because in that scenario, you are landing up wasting a lot more capital, and a lot of rework is likely to happen as you start to get to your product market fit.
This can't be easy, right? Because a founder, especially first time founder who's building a business, and if capital is available, and of course, we've gone through the zero ZIRP era where we had venture capitalists said, if you don't take my money, I'll give it to someone else, etc. So, to kind of take that point of if it's available, take it. But then the problem is once you take it, you must deploy it. You can't just keep it in your bank and earn interest on it. Which brings you back as a founder to the point of okay, if you haven't got true product market fit yet, and if you've raised money and if that money needs to be deployed, isn't that usually where bad decisions get made? Because you got to do something with it.
Yeah, so I
So I'm
think
questioning the take it if it's available
yeah.
logic
And
because
how is that consistent with
yeah,
not deploying it?
correct.
So I see. I would tend to think of these in shades of gray, right? So suppose I'm out there to raise 3 million, and I'm getting 10, right? I would take it, and I would still operate the business in the right sequence, right? Will there be immense pressure from VCs to say, why aren't you deploying 10? Why are you deploying only 3? I think that is a manageable one, right? You're looking for 3, you land up getting 100, right? Now, there I think there is a trade-off in terms of, maybe you don't want to deploy 100 or even over a 5-year period, right? Um, so, so I think within reasonable bounds, you can take more capital and still be um, sensible in terms of how you're deploying it, right? Um, and I think some of this is less a function of what investors are telling you versus what you're telling the investors. Um, Especially in the recent past, like 2 or 3 years, I think there's been more and more attribution of entrepreneurs' decisions to saying, hey, but the investors were pushing, right, in various different contexts. Ultimately, it's you who are building the business. So I think the ultimate accountability of that business rests with the entrepreneur, right? We have to own our decisions. Some of those are going to be bad. But I don't think ascribing those decisions to investors creates the right framework for accountability.
All right. If the Alok Mittal of say 2015 or 2016 were to pitch to the Alok Mittal of 2010, would he get funded?
Uh, 2010, maybe. 2007, no. Right? And this has to do with a little bit of a journey that we went through, learning journey that we went through as investors. And I think in 2005-6, by and large, there was this whole, I want to call it the first cohort of venture capital. Right. Many of us set shop in 2006 timeframe. Most of us had global pedigree in terms of the funds. And hence, at some level, there were kinds of business models that we understood, made venture style returns, and others didn't. And financial services wasn't necessarily, balance sheet based financial services wasn't necessarily a business that was seen in that light. But as we got more experience in the Indian market, I think that view started to get refined. So in 2010, for example, Canaan did invest in Equitas Microfinance, which was a balance sheet lending business. So by that time, I think we had come around to the notion that you can create venture style returns investing in balance sheet based financial services businesses in India.
How, if I may ask? Through scaling?
So there is scale. Second, both. So on the exit side, perhaps because of the scale, the multiples that are available are much higher, right? And inherently, it's a much more of a white space market than a disruptive market, right? So I think those were some of the factors that led us in that direction. And not just financial services. If you look at Canaan's investments over those 9 years, we moved from more and more of concept risk to more and more of execution risk, to taking that risk. Right? So we invested in Happiest Minds, which was Mr. Ashok Sota's third company, but IT services. At that time, I don't think many of us were doing IT services at all. Right? But when we did our kind of back of the envelope math, we could see the venture style returns come by there. So in many cases, we did move to that notion of saying, hey, India is a high growth market inherently. And to that extent, maybe just taking execution risk gets you there. You don't really have to take all the concept risk that is embedded in classical venture capital thinking.
I'm going to read you back something else that you've said, I think, in the past is the Bible of raising money has 3 points. 1, big market. 2, great team. 3, protect the value you provide. What is the third one? What does it mean? Protect the value.
It's the same thing that we call sustainable differentiators, right? Why will you continue to get valued more than other people? And how do you sustain that franchise, right? The fact that there are big markets is available to everyone, right? If it leads to very fragmented outcomes, right, in an undifferentiated market, then in some sense, at a company level, it's a buyer's market and value will get suppressed. So I think that is extremely important. The second piece where that becomes important is, as I mentioned earlier, the cycle of building a business is inherently long in India, right? So in US, average time to exit might be 5 to 6 years. In India, it's about double of that. What does that mean? That means that while in your 4th year, you're still building your company out and you're probably at mid-stage of building the company out, there's already another disruptor, right, who's coming with a new approach, even more relevant to the market now. So I think businesses in India, startups in India have to go through these multiple cycles of building businesses within businesses rather than go through one cycle and get done with it, get done when I say at least in terms of an exit. And we are seeing that in several businesses now, right? So unicorns are necessarily reinventing themselves to say, hey, my current business seems like it's plateauing out and this is pre-exit. And hence, what is the next wave that I can ride on? So I think that is a function of the time it takes to build the business and the opportunity it provides for others to come and disrupt your business before you've really played it out.
One of the things or the points that isn't mentioned nearly as much when it comes to building long-term sustainable businesses is the importance of building an organization. I'm guessing many of the points that you said, that great team, great market, etc. I mean, when it's an idea or when it's an early stage, it's really hard to assess how an organization gets built. But in the process also, it rarely gets talked about that much. What's been your philosophy or understanding of how to build lasting organizations which are beyond the market, beyond the founders, etc.? How do you build lasting organizations?
So I must admit that I'll be speaking from observation here because honestly, Indifi is only 9 years old right now. right? So whether we will end up being a lasting organization or not is very much a question out there.
But you must have bets and philosophies
Yes,
on what you're.
yes,
I mean, that's
right.
all I'm interested in.
Yeah. So I think on that front, I think there are 2 or 3 elements that are important to me, right? And some of those are important to me because just they're important to me. So one is that the organization should be able to continuously challenge itself, reinvent itself, right? As companies get large, there are more and more people who are coming into the company who are coming with a preservation mindset rather than a creative mindset. And you want to make sure that you are nurturing that 15-20% of the people who are coming with the creative mindset, because that is what allows you to ride these waves, right?
How do you do that?
So they need protection. They will fail, right? When I say, those 15-20% of the people need to be nurtured, right? You have to allow them to shoot off the hip. They have to be able to speak in a meeting without fear that if they speak out something which is not necessarily completely thought through, right? If you want to encourage risk taking there, it has to be clear to the entire organization that risk taking is okay, right? So one of the things we try to follow in our company is if you fail, that is fine, right? But we expect that you've done a thorough job of failing, right? Now it's easier said because people are looking for evidence of that in the leadership's action, in the founder's actions, right? But that's, I think, a very important trait that you want to build.
How do you counterbalance that with many organizations, the need for people to feel that there should be consensus? Because when someone often, I mean, these 15-20% of people who are creative or who are like, shooting from the hip, like you said, sometimes the ideas will not lead to consensus.
Yeah.
So what's your...
Yeah, I would bring the portfolio mindset to this, right? Just like we do it in venture capital. Yeah, sure. So, you got $100 million of value sitting somewhere. You're not going to shoot off the hip and put that to risk, right? You need $100,000 to experiment a new idea that could be, if successful, could be much larger opportunity. You'll provide that opportunity, right?
Something very similar was said to me by Amit Agarwal of No Broker, who said that internally they run it like a venture capital firm where somebody wants to run a business, they're allocated capital, they're asked to make a bet. So in some senses, they contain the risk
Yeah,
of...
I'm not sure whether we have been able to do that. And I think the basic challenge here is that things are not necessarily defined, as units when they come up for experimentation, right? The product manager will come up and say, hey, I want to try out these 3 things. Right? It's very hard to take a VC mindset to that because it's not a isolated piece of the picture. It will affect other things.
It has to connect back to the rest of the business and the business
Right?
model.
What's going to be the pricing model? How our customers going to feel about it? Is there a customer facing risk that we're adopting? And to that extent, I think the notion in which you can run it like venture capital is actually a good, simple notion. So today, for example, Indifi is looking to diversifying in new product categories. There are 2 such categories we've identified. Those we are running like venture capital. We've allocated capital. We are building separate teams for those. But that's the easier part. The harder part is how do you get this to be part of every decision, every function that you're making, which inherently is intertwined with the rest of it. So it has a notion of one way in which it is similar to venture capital is I want the bets to be small, I want the readout to be fast, and I want the upside to be high. Right? All 3. If the upside is not high, it's not worth doing. If the readout is long, we have to
Sorry,
figure
what's
out.
readout?
So is something working or not?
Okay.
Right? Can I read an experiment out in 30 days? If you're telling me that I can read an experiment out in a year, that's too slow. That doesn't allow me to iterate. So then, let's spend more time on saying what is really the bet we are making, right? This is like you don't need to launch a product to assess its demand. You can put a sign-up page, right? Trivial example, but it allows a quick readout, establish confidence in the hypothesis, right? So I think in those aspects is similar to venture capital, right? Venture capital says, let's risk $500,000. Let's see if something is working. If it does, then we'll put another five. You're staging capital. You're staging investment. But in the sense of it being a entity in isolation, it's not like venture capital. This is all through the organization all the time.
Are there examples of bets that you've made that have potentially ended up in failure and you've learned from them?
There are more failures. We don't learn too much from them. My own experience is if you tried something and failed at it, it's worth being back on the table in 18 to 24 months' time.
Because it's usually a timing issue rather than a...
It can be a timing issue. It can be an execution issue. It's very hard to separate the bet from the execution. So we try not to learn too much. In fact, we see that organizational memory is a barrier. Sometimes some of our people who've been with us for a long time will come and say, but, in 2017, we had done this, it didn't work. And 2017 is...
That's a very powerful thing, right? Like just because it didn't work in the past doesn't mean it's not going to work.
Yeah. And it doesn't mean that we throw away those learnings. We still want to say, okay, why didn't it work there? Right. So one of the businesses that we are operating in the venture mode, we have failed thrice at that. We've not built a good business there.
But what keeps the idea still alive? That why
the sense of opportunity. Right. So the source is, if it succeeds, then it should be big. So as long as that is true, then I think it is worth multiple shots. It's not worth the same mistake again and again, but it's worth multiple shots.
Do you believe in this concept of founder mentality?
Ownership, yeah.
Yeah, and connected to that, slightly unrelated, is there, do you feel that, especially with founder-led organizations, startups, etc., founders have this larger-than-life importance in organizations for the right reasons? They started it, they hire a lot of the people, the business model comes from them. But at some point, it also prevents the organization from making that leap to not being dependent on founders. Is that something that you've been trying to kind of work? Have you reached a stage yet where you think about how will Indifi work if the founders aren't around to guide it?
Yeah, so I think in case of Indifi, we've been able to kind of get there. So today, we do have a CEO in the company now. And I think we are lucky to find a person who displays the same founder characteristic, even though that person is joining us several years after the company is founded. And down the line, in the mid-management, and I think that is the core of this, right? I think the organization is held together by mid-management, not by leadership, right? That's the translation layer between what the leadership is wanting to get done and what gets done. And so I think at that layer, we've got people who behave like owners. Some of those are people who've been with us for many years. So, they practically have seen the company since we were zero. But there are people who joined us last year and they're displaying founder mentality. Now, the question becomes, what do you do with them, right? Do you lock your organization into a seniority mindset? If people have been here longer, do they...
The tenure mindset, so to speak.
The tenure mindset. So I think those are the harder ones. The challenge with much of this is by the time you realize that some of these biases have set in, it's too late. So in some sense, you need to be a bit more proactive about, hey, I'm seeing some behavior, right? I can react to that behavior, but what is the message I want to send out, right? And hence, is there a thread that we want to build, which is called culture?
What's your views on culture? I mean, what are some of the specific or perhaps unique things that you do at Indifi specifically focused on culture to ensure that, its culture is differentiated?
So I think I've gone through a couple of different cycles on this. And again, hopefully we've learned from what hasn't worked for us. There is this whole notion of defining culture, defining values in a company, and then creating a implementation rubric to it, right? What will you do in recruitment? What will you do in appraisals? I think culture inherently is formed by what happens on the floor every day. And to that extent, discovering culture is almost more important than defining the culture, right? What is the behavior that gets rewarded, on the floor? What is the behavior that gets reprimanded on the floor? Right? A lot of that flows from the leadership. So when I say flow, it's not necessarily bottom up. But if we want to promote risk taking, right? Um, then we have to be able to uh, almost instinctively react correctly to both successes in risk taking and failures in risk taking, right? And to that extent, I think, sorry, um, authenticity is the cornerstone for culture. I don't think, if I start another company, you will see very similar culture shape up, right, to what I might have done here or what we have done in JobsAhead, right? I'm still the same person, right? While I have different co-founders, I've been lucky to find co-founders where we share the values.
What is, I mean, it's a phrase which is used a lot, authenticity. What do you mean by it?
Let me take some examples, right? So in my company, I'm not the person who goes out and will give a high five to people as a means of motivating people, right?
Because
Now
that's not you.
that's not me, right? And my entire team will tell you that, right? Uh, but if there are good ideas on the table, right, then there's an openness to see them and to promote them, right? I will hold myself to a higher level of performance than I will hold any of my team members to, right? Now, in a company where you have the type one person who's motivating people through their persona, that will become the culture. And it's okay, right? I don't think there is a single unique successful culture, right? In a company that I am setting up, the kind of values that I am displaying will become the cornerstone of the culture. You'll, those kind of people will end up being more successful. They will end up growing, right? If I try to be the first one, it's going to be a mess, right? Because I'm saying that that is what we should be, but that's not my instinctive response when something happens in a meeting, right? So that's what I mean by being authentic, of saying, your ability to accept who you are.
And be consistently that.
You will be consistent if you accept who you are, right? The inconsistency comes from you trying to be something that you believe is right, right? So there is this whole, at one point in time, the GE culture was the culture, right? And sure, for the people who ran it at that time, that was an authentic culture. It was successful, right? But once it became the template of what a good culture is, everyone tried to fit that, and it wasn't authentic anymore.
What kind of people don't succeed at Indifi?
So I think there are some ground rules that we have set, right? One, we will not tolerate politics, right? An iota of that. Right? As soon as we see the first signs of it, we will cut that out. Cut that out doesn't mean firing the person. Cut that out means having a conversation with the person, being brutally honest about this is not the behavior that we'll tolerate. Give them an opportunity to correct. So even today, uh, if you walk in meetings and so on, you will see none of that going on, right? And this translates across levels in the company. Right? Once you set that rhythm, that is what gets followed. Second, for example, we like to rely a lot on data, right? And so there is a strong bias towards being able to bring data to present a case or accept that you don't have data and present your conviction and reasons why you feel conviction, right? So people who aren't comfortable with data, especially at leadership levels, find themselves as C, right? And it's not to say they are not good people or they won't be successful elsewhere, but in our system asks them for, hey, why do you think this is the case? And if there's a person who comes up and says, hey, I spoke to 25 customers and this is my gut, that's fine, right? So we would count that as data. Right? So that is the second place we've seen. So how you manage people. Uh, we've seen some failures there in our leadership. Data has been an issue. Focus, right? Again, are you willing to make that bet, or is it all diffused? Right. So I think we have both, in terms of people not being successful in Indifi, but also certain initiatives not being successful in Indifi. I would trace them back to this notion of, okay, did we have a sharp bet, or did we say, "Ye to ho jayega," right? And there's some risk here, some risk here, some risk here. So we didn't really know, what we were solving for. So I think some initiatives haven't worked out because of that.
One of the questions I often ask guests is, what's their favorite open-ended question when they're interviewing talent?
uh, you know, um, I like problem solving. So when I'm interviewing people, normally I would go back to puzzles, problem sets,
What's the thinking behind that?
to see the thought process of the person. Right? What do they do when they get blocked? Right? Do they give up? Do they continue to struggle with the problem? I still remember this. Might have been 4 or 5 years back. This is one very junior person I was hiring, and we had the interview, asked him puzzle. Couldn't get through. That was fine. And then the interview was done. It might have. I was back at my desk, and this guy walks up and says, "Hey, I just thought of something." Now, I don't know whether the person was trying to do it because they wanted to still be considered, right? But just that fact that the person continued to struggle with the problem, I think is valuable. It also, you know, uh, kind of brings out the creativity in people. How are people thinking about it? And so normally, if someone's kind of suggesting one line of thought, and you throw another line of thought at them, are they catching that? Are they exploring that? Or are they still committed to that just one line of thought? I think those are some interesting pieces that come out of it. Second thing that we try to establish is how much of the success they got in their previous jobs, right, was there doing, and how much of it was part of just the
Rising tide.
rising tide.
How do you assess that?
Those
I
are
mean,
those are
what
those are relatively simple ones, right? Just so you ask them, what was the business like when they came in? What is it that they did? What worked? What didn't work? Right? If everything is working, means they don't have a clue.
What is your view at succeeding at a career over the long run? Because what we knew of careers is increasingly getting shortened, disrupted, threatened. Whether you look at entry level careers with the rise of
Yeah.
AI, whether you look at 35, 45, 50 plus careers getting disrupted because middle management, senior management. So, our notion of what we thought of as career is no longer what it was. So, what would be your advice to someone who's entering college or
Yeah, I
getting
think
a
I
job
think
to think about your career?
I want to first kind of just the notion of succeeding at a career. I think the notion of success is the more important one to question, right? And that is different for different people, right? So again, this I have had an opportunity every 5 to 7, 8 years to just completely give up what you have and start afresh, right? For me, that is success, right? For someone else, having 25 years in one domain and mastering that could be success. So I think the notion of success itself is a little bit contentious or variable across people. And to that extent, saying
Or it's
that
individualistic.
it is very individualistic.
So,
So
what would you tell them? Follow your heart?
follow your heart
It
tends to be
sounds very
very broad.
genuine. That's
Yeah,
right.
right. So, but I think figuring out what you enjoy doing, what really gets you to work every day, I think that's critical. Right? And people will still have goals of saying, I need a certain degree of financial independence, right? Things of that nature. Those are not necessarily conflicting with the notion of what is really that drives you, right? So for me, it's problem solving.
I was about to ask you, what
Yeah.
is it that really drives you?
What gets me in every day is problem solving, right? So I want to be able to look at a problem and say, hey,
This is the solution.
I don't know whether this is a solution,
But
but
at least it's
these are
you're
the three
working on it.
choices. Let's see. So it's not like we've solved for MSME credit, right? We are 0.1% or 0.01% of the MSME credit market, right? But we've added to the body of knowledge, right? And that's satisfying. And we know that if we have to be a significant player in the market, we have to grow, 10x, 20x from here. We will have to solve more of those problems, right? But that is energizing.
What is it that all of your direct reports or colleagues will agree about you?
Uh, they will agree that I need to be more sensitive when dealing with people. They will agree that I will bring a certain quality of intellectual excellence to the table, but I need to bring more of empathy to the table. I think those are some of the things we have these conversations, so I kind of know what they would agree on.
And your this thing is that this is who I am. I'm being authentic. I'm not being harsh to anyone. This is just the way I work.
No, so I think being authentic is not again inconsistent with continuously improving who you are, right? So my response would be, I hear you, and if I accept a certain argument, then I would accept it, right? And then it's up to me to see how I improve. In fact, uh, sometimes children bring the best out of you on this, right? So my daughters are both in college now. I don't know when I was speaking to my younger one. She's in second year now. Maybe it was a couple of years back. And she said, when we were young, we thought you were khadus. I'm like, acha kya hua? So my daughters are telling me that, hey, over the last 4 or 5 years, we think that you've gotten much more empathetic than what you were 5 years back. Now, there's no way under the sun that my people are not feeling the same way.
What's it? I mean, I had another founder earlier today say the exact same things, that in the last 4 5 years, I think I've gotten more empathetic, even though I'm doing a startup which is more stressful.
Yeah.
So, what is it? Is it that when you're when you're a founder and you're in a situation where you need to be responsible for the answers and the future and the vision, etc., it in some senses calms you down? Is it something else? Is it age? I mean,
It could be age. I'm just thinking aloud about it. So, see, again, my notion of what I deemed to be success when I was 35 is certainly different from how I'd look at it today, right? So, when I was 35, I would have been bang in middle of my Canaan journey, right? And,
how old are you today, if I may ask?
52. Yeah. And at that time, the public visibility that a venture career brings you, I found that very exciting, right? And that itself gives you lends a degree of arrogance, right? Today, that's not important for me, right? So I think age might have to do a little bit with it. I think it's also perhaps a degree of realization, and I've seen entrepreneurs who at a very young age come to that realization. So maybe I'm just late at that. Is that your success is depending on everyone around you. In some sense, you're responsible for them, not just as a boss, but also as a person. So I think over the course of Indifi, that is probably one of the things that I feel more and more strongly about. But I don't think that is something which is age linked. I literally have 25-year-old entrepreneurs who are great at that. So it just is a different point in time.
First Principles is a team effort. Hari Krishna assists me with research and questions. Anushka Mukherjee produces the episodes, and Rajiv CN masters our sound and audio.